Hello, everyone. I'm Ray Clausen, Executive Director of the Profitability Analytics Center of Excellence. And I'd like to welcome you all to today's webinar, From Cost Chaos to Clarity, Unlocking Profitability with Impact ECS. We have two distinguished speakers today. I'm excited to hear what they have to say. Our first is Reema Chakravorty, who is Profitability Solutions Lead with 3C Software, and Sam Smith, who's Costing Solutions Lead with 3C Software as well. These are both areas that are very near and dear to our hearts at Pace, so I'm looking forward again to what you have to say. For those of you who aren't familiar with Pace, we're the Profit Analytics Center of Excellence. We're a group of volunteer professionals dedicated to helping organizations make better, more informed decisions through the use of data analytics. If you want to become a member, it's free. You'll get access to all of our resources. Just go to profitability-analytics.org and sign up. Before we start, there's a little bit of housekeeping I want to go over. If you want to receive a certificate of attendance for today's session, please be sure to use your actual first and last name when you sign in. If you need to edit your name on the screen, click Participants, which is at the bottom of your screen, and then hover over your name on the list. Click the three dots, and there's an option to rename. Please note today you have to attend at least 50 minutes of this presentation and answer at least 3 polling questions in order to receive your certificate. This session is being recorded, so please keep your camera off and your microphone muted. We will be answering questions throughout the session, so please put them in the chat feature, and we have someone who will ask the questions for you. Over to you, Reema and Sam.
Thanks a lot, Rafe. Good morning, good afternoon, good evening, everyone, depending on wherever you're joining us from. Happy Thursday, and thank you so much for joining us today for this webinar. It's a little gloomy and overcast here in Atlanta, but we do have some fun stuff planned for you today with a live demo. But before we get into all the action, let's talk a little about who we at 3C are, what we do, why we believe so strongly in it, and finally, the how we go about it. I promise to try to keep it short so we can focus the majority of our time on the demo and relating it to the real time situations, which would be more applicable to you all. And like Reef mentioned, if you have any questions on the way, feel free to ask them on the chat and we'll address as many as we go. So, as for today's agenda, we'll first start with the who's, and before we get into the why, highlighting the challenges within costing and profitability, giving you a primer on the software itself, and jumping right into some real time use cases and seeing the product in action. So on that note, Sam, why don't you start us off by telling everyone a little about yourself?
Yeah, thanks, Reema. So everybody, my name is Sam Smith. I'm the costing solutions lead with 3C, as Rafe mentioned a moment ago. That means that I tend to focus more on our clients in the manufacturing industry who are making physical products versus financial services, healthcare, or distributors who don't necessarily have the manufacturing side of things. Prior to joining the sales and solutions team, I worked across all sort of other groups of the company, whether it was implementation and consulting, the product team as well. So I have some great experience and background in those areas. And you know, I started my career and journey in the financial world with at Ernst & Young, being consultant there for many years prior to joining 3C. That's it. Thanks, Reema.
Perfect. Thanks, Sam. And as all of you would have guessed, my name is Reema Chakravorty. I'm the Profitability Solutions Lead with 3C Software, and I tend to focus more on the costs incurred beyond the traditional COGS, in addition to how to best report, summarize, analyze profitability within organizations. I have a background in sales, and I have worked in the financial stream, helping understand how to build these solutions over time, and been with 3C for over 7 years now. So with that, let's get a little into more about what 3C is really about. So Sam, could we go to the next slide, please? So 3C Software was founded in 1989 and is still today a family-owned business. We're based out of Atlanta, Georgia, with a sister office in Sydney, Australia, and have well over 700 implementations across the globe. Our software platform is called ImpactECS. All you'll hear us refer to it as Impact sometimes for short. We started the business about 36 years ago, and Impact ECS was what we had invented and gone to the market with at that time. And while it has certainly gone through tremendous updates throughout the years, it's still the only product we offer and sell. And really, that is what ties into our core value specialization into one particular area of focus within the overarching world of accounting and finance, which is costing and profitability analytics. So, having said that, the next slide, please, Sam. So, having said that, what is it that we are hoping to achieve in today's webinar? Our objectives today are really clear. We want to explain how centralizing cost and profitability into a platform can help solve key challenges. We will dive into some core features of Impact ECS. We look at some real world results from a customer case study. And last but not the least, we will help you identify from that case study actionable steps you can take within your organization starting today. So moving on, let's get into now that we've really covered some part of the who we are, let's get into the why part of it. I'll give you guys a minute to just kind of really read this statement and soak it in. This stat comes from BCG last year, stating that 65% of C suite executives are prioritizing specifically manufacturing and supply chain costs in order to gain or even maintain a competitive advantage. And I'm sure most of you here will agree that if the last 6 months are anything to go by, this is only becoming more and more prudent by the day, if not the hour. So, having said that, what are some of the common challenges we often find companies struggling with in regard to costing and profitability? First and foremost is the clear lack of visibility into the analytics process itself. So often we see people using one off copies of old Excel workbooks, manually calculating KPIs, and we cannot stress enough the risk of tribal or institutional knowledge not being documented and systemized in any manner. Not only does it put your business at risk for being overly reliant on a specific person or a team because they're the only ones who know how to do the task or a process, but without the clear visibility of how the cost and profitability is being calculated, we find that people often tend to question the results and don't trust what it is. Now, the next thing that we've seen a lot of companies suffer from is the part of juggling multiple data sources. In today's tech crisis, companies are pulling data from at least 5 to 6 different systems. Where's the struggle? Each of those The data from each of those systems has to be manually downloaded and massaged into something useful. Not only are you at a risk of making a mistake and manipulating the data manually, but there's also no repeatability, making it a challenge to recalculate the same statistic for another period or drill into another level of detail. Could be at an individual customer level or a product level or any other detail that you might seek important. And finally, you need to have the right data in the right place at the right time in order to make the right informed decision. A lot of people tend to agree on the right data part, but having it at the right place at the right time is equally important, if not more. Because if you don't, you will be making the decisions without an up to date analytics, which kind of defeats the entire purpose of having your data in place and kind of getting your decisions out of it. And the right place really matters because everybody needs to have it at the right time and at the same time, because everybody needs to be on the same information. Otherwise, sales could be making information seeking one particular set of data, whereas the procurement is making the same a whole different set of decisions with their set of data. So that again defeats the entire purpose of not having a centralized cost system. So moving on. Oh, we've spoken quite a bit right now. So I'll just take a minute and let's try to sink in whatever has been spoken, and let's take a quick poll. Reef, I'll hand it over to you.
So the first question is, which of the following is the primary reason organizations struggle to generate actionable cost profitably insights? And select one of the four: fragmented models and disconnected data sources, over-reliance on fully automated ERP systems, too much visibility into cost drivers create confusion, or most costing processes are audited in real time. So remember, you have to answer the 3 polling questions in order to get our certificate of attendance for today's session. Okay, we're going to finish the poll very shortly. Please respond if you haven't. And we see that almost unanimous response is fragmented models and disconnected data sources.
It's good to know that people are listening.
Good.
But yeah, I guess it's also right that there is some amount of the other answers could also be a little applicable. But yeah, the biggest challenge that we have seen is fragmented models and disconnected data sources. So thank you everyone for participating in that poll. Now that we've looked into some of the issues and reasons why it is important to have a central cost and profitability tool, and I see that most of you agreed with us, let's see how 3C really fits into the overall puzzle. We integrate with pretty much any financial and operational system that your organization may use, hence helping automate the centralized part of it, the flow of data, and systemizing the analysis process. This helps make the decision making process more repeatable, more accurate, and more reliable. And now that we have the process part of it, we also have a set of experts in the costing field who help make sure that the cost and profitability models are built with in respect to whatever you're looking for to make the entire process completely seamless and integrated and centralized. So moving on, this is all talk, but here is some proof of what we have done in the past, and this is some of our a small sampling of who our current clients are. And what I think a key takeaway from this list is that you will find companies across a variety of different industries. You can see that we have food and beverage, we have semiconductor companies, we have building materials, we have chemicals, we have consumer goods, we have automotive, pulp and paper, etc., etc. So all of these companies and industries each have their unique set of challenges and questions to answer. So it's our software, Impact ECS, and our modeling approach that we follow that helps make it adaptable to help solve the needs of each one of these industries. So if we drill in more on the term that I just used, model or modeling, what does it really mean? Because it is a very dear word to us at 3C, and that is what we're kind of based on. We call Impact ECS a modeling tool, meaning we don't have a rigid or a prescriptive approach to exactly how we calculate cost and profitability. We build within the software a unique model or models for each of our clients that takes into consideration their business processes, KPIs, and performance matrices, calculation methodology, terminology, and workflow to deliver a custom configured solution providing the exact requirements to each customer's unique needs. Uh, to explain this a little further, we like to use the analogy of Microsoft Word. When you purchase Word, you don't purchase a set of pre-written documents for what to use when applicable. What you get is a platform which you have and all the tools needed to create whatever document you're looking for. So you could probably write a two-liner email template, or you could draft a 10,000 page novel with images. It really depending on what you want, but you have the flexibility to do what you want and choose what you want and how you go about it. Impact ECS is similar, where you can use the built-in tool to set a construct or to construct the costing profitability model the way you need it to get the answers that you want when you want it and how you're looking for to represent it or show it off to other people. So I hope you got that message in. So now that we've spoken about what it is that 3C can do, let's really see in the whole landscape of financial and operational systems, where would 3C really fit, or how where would Impact ACS sit on the landscape? If on the x-axis we look at the simulation capabilities, and on the y-axis we look at the robustness of the system, let's talk about the different bubbles that we have plotted on this. Let's talk about the transactional systems first. So starting with transactional systems, like your traditional ERPs, you would see that they are on the top left, because they're very robust, and there's no doubt on that. And but they often lack the flexibility to quickly and smoothly run financial simulations. Next, let's move to the bottom left, where you have niche systems like the AS400, Microsoft Access, and other homegrown systems that we often find are neither overly robust nor flexible enough to run simulations. Then let's look at some. If you move to the right side, you would see that you have the data visualization tools like Tableau and Power BI. These are great systems for reporting purposes of data. but they often struggle with having the calculation engine to powerfully manipulate and create new sets of data needed to run current certain simulations. And then if you move further up, you have desktop applications like Excel and Google Sheets. Very flexible, very, very good for immediate answers, but are absolutely brilliant, but for one time simulation and analysis. They unfortunately lack the robustness to systemize the process in a repeatable and reliable manner. And that's where, you know, that's where we find the gap, and that's where 3C fits in, and that's where impact comes in. It is nearly as robust as what your traditional ERP systems are, making it reliable and accurate, and it also gives you the flexibility to run various models and scenarios, making it ideal for running business simulations. So, given that, let's get into the second poll question and your chance to get your second answer right.
Let's see how folks are listening. Which of these best describes how an enterprise cost and profitability system differs from ERPs, spreadsheets, and BI tools? So again, select one of the following. It focuses primarily on data visualization and static reporting. It is a standard transactional system used for accounting journal entries. It integrates data and provides robust simulation capabilities, or it's an out-of-the-box solution with no customization options. Again, please make your selection quickly so we can end the poll. And I think we have a attentive audience. Almost unanimously, it integrates data and provides robust simulation capabilities.
Hi, Reema. Now that the poll is closed, I'll pop in with a quick question for you if you don't mind.
Of course.
And I'll also say this, we're accepting questions in the chat box. So if you have one live, feel free to stump our experts. They're happy to answer them. You know, one of the things, Reema, you talked a bit about modeling and why modeling is important, right? And understanding that. But you know, some of the things that we hear, I think, from our customers has a lot to do with how we're able to translate and share the information that we get from models, and how do we sort of tell the stories of what's happening, right? Like it's cool to be able to do the math part, right? But talk to me a little bit about how the models give you sort of the skills to be able to do the job.
Wow, that's a great question. Thank you so much, Stacy. And really, it is key to what we do and what we want companies to understand why they need a crucial system. It it is something that is not getting enough attention in today's world. You know, cost engineers are sitting on incredible, powerful insights, right from understanding what's driving margin erosion to which products are truly profitable to how overheads could be impacting the unit cost to just understanding where is the cost getting impacted. They have all that information, but they're not being able to communicate or make a story out of it because nobody can really figure out where the numbers are coming from, or they do not understand as to how that insight has got built up, and they cannot share that data with anybody. So I know as a cost engineer, they have the ability to get all the data together, get the complex calculations done, figure in the logic, and put in the assumptions, and turn any story that resonates with the decision maker who doesn't want to live in the details. So that means explaining why something costs, what it does, what's changing, and what the business should do about it without overwhelming the audience with data. That is where a centralized cost and profitability tool can really help. It can help build the story right from the start to the end, and still give you a very simple and a basic picture, so that you can communicate and say that, look, this is where the issue is, or this is what we can do better, and this is how we can really talk about what we should do in the future and how that would impact all of us. So you can trace it back to the source, show the impact, and create a visual scenario based output, so that the executives who don't have much time to probably go through everything can just kind of understand it simple and easy. I hope that answered the question.
No, absolutely. I think that's a great observation, right? Because, you know, now that we're in this world of there's a lot of information available, right? You can calculate many things in your day-to-day life, right? But just getting the number, it seems like it isn't enough anymore, right? And how do you go beyond just calculating the answer, but really sort of making a difference on it? So thank you. Again,
Thank
questions
you.
in the chat, so feel free to drop them in as we're going, and I will interrupt these guys with more.
Um, all right, so I promise to keep it short. So the last thing I really want to leave you all with before we dive into the product and case studies is what really makes this all work together, and it is the people that we have within the organization. Everyone within our organization, from the implementation and product teams all the way to up to our CEO, have their own title and role, but we truly see ourselves first as cost accountants and financial analysts. We Each one of us out here is truly passionate about cost and profitability and how we can help people understand the intricacies of it and how they can do better so that they can improve the costing and profitability process in their own organizations. We've been building profitability tools for over 35 years with a great mix of talent, some of who have been building the models with us for over 15 to 20 years. And there are some others who have come from the industries where they understand the true struggles and requirements firsthand because they've kind of lived it day in and day out in their roles. So everyone here has the technical capability to know how and deliver industry industry leading models, helping our clients make better, more informed decisions. And now Sam is going to show us all that I have spoken about, and I'm going to turn it over to him, who will show the real meaning of chaos to clarity and how you can unlock profitability with Impact ECS. With that, Sam, take it away.
Yeah, thanks, Reema. So quickly before we dive into the software, I just want to lay something out. This graphic here is the framework that we utilize within the model building process. So our solutions span each one of these areas from cost to source through cost to make and manufacture all the way to cost to deliver, right? And we develop models within each one of these specific areas to help our customers. But where the model truly becomes powerful is when you're able to tie all three together and are able to analyze across the entire value chain in one end-to-end platform. So with that said, let's take a look at what this might look like, right? I'm going to take you through some use cases within each one of these areas, and then how we tie it all together in terms of reporting end-to-end cost and profitability. So the first example we're going to look at is on the cost to source side of things. And the challenge is something that I think resonates with a lot of folks nowadays, and that is being able to effectively run tariff simulations and understand what the full impact of potential new tariffs are on purchased parts or materials, right? So what we've done in the solution inside of ImpactECS is be able to consolidate desperate data sources like material masters and supplier data, shipment information, and also some publicly available tariff data that's, current tariffs, with some internally created data on what tariffs might look like in order to run a simulation, be able to calculate what the fully loaded and landed cost of a part is. So with that said, I'm going to switch over to the software itself. Sorry, that's the wrong screen. And do a quick tariff simulation cost object, as we call it, right? So what we're doing here in this cost object is we are going to analyze what the impact of tariffs are one particular SKU at a time. Now you can certainly roll this up to do categories of SKUs or parts that you're purchasing, or all parts at once, right? But really to understand the details and nuances of it, we're going to take it off, or we're going to start at the lowest level, being one single material, right? So I'm going to go ahead and select a material for us to look at, right? I'm going to select to start off with just a screw that we're purchasing, right? So when I've selected it, you'll see a few things have happened. One is we get some high level data, the description of that part that we saw there in the drop down list. It is a raw material that we're purchasing. There's the weight for it, a couple other metrics like length, width, and height, just some actual material master data. And from here, we can go ahead and just start manipulating and playing around with tariffs, right? So we need to know where we're purchasing it from based off of our supplier master data, the actual data that coming through. We're right now purchasing this part both from China and Mexico, right? So let's see what happens when we start applying some tariffs. I'm not going to get into what tariffs might actually be. I'm not an economics expert or a policy expert in that respect. But let's say if there was, a 60% tariff being applied to China, and then we can, go ahead. I just hit the tab button to add a new row. You could also add rows and remove rows down below. we can go ahead and select our other country of origin, Mexico, and maybe that's going to have a lesser trade tariff. So we're going to give it 30%. I'm going to go ahead and calculate the results. It's going to make sure I want to save the changes that I've applied, which of course I do. And now that it's calculated results, I'm going to switch over to the supplier analysis tab and see what's happening. So let's start with seeing that, we can see we have two different supplier IDs, unique supplier IDs, but across 3 lines. The reason being, for this supplier coming out of China, we actually have 2 different ship from locations. So despite having the same base price because it's the same supplier, there might be some other costs that are incurred that are affected based off the ship from, right? So we can see here the freight rate is different depending on which port of origin it's coming from. There might also, as we go down through some other columns, be different insurance rates or other cost buckets that are affected based off the ship from itself, right? So as we continue out across the columns, we can see a few things. One is this HTS cost, right? So HTS stands for Harmonized Tariff Schedule. This is the publicly available data, the known data that we've integrated with coming from the US government, and it's applying what the standard tariff is at the individual part level based off the country of origin, which in this case being a stainless steel screw coming from China and Mexico, by default, they had the same tariff rate of about 8.5%, right? We then get into any specific discounts or country-specific tariffs, right? So USMCA is a trade agreement we have between Mexico and Canada. So we have an 8% discount because of that on the supplier coming from Mexico. Section 301 tariffs are a specific tariff from Trump's first administration applied to Chinese suppliers. So we can see we have an additional 25% tariff coming on that supplier, those suppliers' lines. And then finally, we get into the actual what if side of things, right? So we applied a 60% tariff additionally to the parts coming from China and additionally 30% from the parts coming from Mexico, right? And we can see what the actual value is of those what ifs being applied to the base price. That's going to result in both the current tariffs that are being applied, right? So currently, as we purchase it, we're paying a little over 50 cents per part coming from China and a little over 1 cent per part coming from Mexico, right? Or we have basically a 33.5% tariff rate from China or a 0.5 tariff rate from Mexico. When we apply our what ifs, though, we see these dramatically tick up, right? We had a 60% increase on the Chinese one, and we had a 30% increase on the Mexican supplier, right? And so now we can get into what our total landed cost is. So I'm going to collapse some of these and expand some more columns. And as we go across, you're going to see we're not just considering what the base price and freight is, but some other cost buckets as well. In order to land the goods here to this business, we need to be able to include both insurance on the freight or on the shipments themselves, what a carrying cost might be once it's landed, any off quality or shrinkage that might come from the particular supplier, right? All these are going to result in what our total fully loaded, fully landed cost of the part is, right? And we can see here that the least cost part is going to be coming from Mexico with the total cost of $7.85 versus the $8.20 or $8.18 from the supplier in China. I'll mention you might think that this is expensive for a screw. Really, what I should have mentioned is we can see from some of the weights and height length data from the material master itself. We're buying a box or a quantity of 1,000 or a couple thousand of them at once, right? So that's why we have a total cost of in the $7 to $8 range. I'm going to look at one more example of this because it's not just raw material parts. Sometimes we're buying sub-assemblies that have been manufactured by a contract manufacturer. And this example has a few more suppliers to take a look at, right? So now switching gears, this is a little bit more of an automotive example, right? So our sample part here is the door latch for a Ford F-150 on the driver's side. We can see that we're actually purchasing a whip or a sub-assembly. We can see the same metrics, height, weight, those sorts of things of what this sub-assembly is. If I come down to the tariff entry screen again, we can see that now we're purchasing it from Canada and Mexico as on a historic basis, right? So let's apply a 40% tariff rate to Canada. I'm going to add another line, and I'm going to apply to Mexico the same 30% tariff rate that we had before. And then I'm going to go ahead and hit calculate, saving the changes once again. And as we come over to the supplier analysis tab, we can see now that we have, a few more suppliers, 3 coming from Canada and 2 unique suppliers coming from Mexico. We can see the ship from locations, and then once again, we can see the base prices and freight per unit. We go through the exact same columns that we saw before, the harmonized tariff schedule, USMCA discounts, no Section 301 tariffs because China's not a factor in this scenario that we're running, the current and total cost, right? And what I find interesting in this scenario is that despite having a higher tariff rate of 40% in the simulation that we ran, we can still identify that one of our suppliers from Canada has the least cost in terms of what it is to buy this landed sub-assembly, right? So we have a cost of $92.93 versus the least cost from Mexico being right at $93, right? So that's really everything I had on the tariff simulation and cost to source. I'm going to switch back here to the slides just to introduce our next use case. So use case number 2 is a simulation or a what if scenario around overhead rates. The challenge here was that during the planning period for an upcoming fiscal year, this customer of ours was really struggling with dynamically changing volume forecasts, which they were using to drive dollars and calculate overhead rates, right? Their commercial teams were on a weekly basis, updating what the final volumes might be in the product mix. And from there, the financial team would constantly be trying to recalculate what a new overhead rate is, but also be trying to recalculate what the total pools of spending need to be to support that new product mix and sales volume. And now the solution was in ImpactECS using the budgeting framework that they had already built in sort of their standard cost model, we're able to quickly dynamically simulate what the changes to overhead spending is based off the finished good volume, and from there calculate a new overhead rate. So I'm going to switch back to the software in a new screen now, and you can see that we're inside of another model, right? We said model, the word's very important to us. It means something literally, and this is a different model. And what I'm going to do is I'm going to navigate into the what if scenarios portion of this model. And I'm going to open one up here that I've called overhead demo or OH demo, right? You can see when this drop down, we have several other areas in which we're running overhead simulations within the model. Unfortunately, we don't have time to go through all of them today, so we're just going to look at the overhead, which I think is my favorite one. So a few things that I'll quickly level set when we open up this cost object. We have, first and foremost, a retention of this what if scenario, right? Sometimes when you run a what if scenario, it's just an answer that you need quickly and you don't really need to keep it around for long. So you might say, hey, let's keep this answer around for a day or a week, or maybe let's keep it around forever, or until the end of the year, that sort of thing, right? But being able to sort of manage the data and the scale of data within the model intuitively, and not necessarily over the years stack up thousands of these what if simulations, having the model itself and the system take care of sort of the data cleanup for you. And then finally, we need to select a version of cost that we're going to base this simulation off of, right? So I've selected our fiscal year 2025 standard, that this is what we're going to run the simulation off of. And as we come here into the cost changes tab in the bottom section of this object, we can see several things. First is we have different areas of spending, and based off the fiscal year 2025 version of cost, what we're spending in each one of these cost pools, right? We have fixed and variable spending, and then finally the total spending by category. We have the sales volume, which we're using to drive the dollars to calculate what the total dollars per kilogram is. I'll mention in this model, this is a poultry customer of ours in the food and beverage space. So they measure everything on a per kilogram basis and tend to apply costs on a per kilogram basis as well, right? So for each one of these categories or pools of spending, I can do several things in terms of manipulating what the overhead rate's going to be. Let me collapse these columns back down. I can just manually set what I want the overhead rate to be. So right now I have an overhead rate of a little over or almost 20 cents. So let's say, for this pool of spending, I want to set it exactly to 25 cents and see what the impact is. I can also change my sales volume, right? So we have a sales volume right now around 89 million. Let's say if we made that 100 million, let's make sure I have the right number of zeros. Yes, I do. So we can set a new current sales volume, or alternatively, we can just change what the budget is for the same sales volume. So on this line, I have a budget of around 14 million. Let's change this to 18 million instead, right? Now I'm going to go ahead and hit save and calculate here and see what the impacted results are, right? So on this first line, as you expect, we're just setting manually what an overhead rate is. So the new overhead rate is 25 cents in terms of your admin cost. On the second line, I've changed what my sales volume is, right? So what's neat and unique about this model is that, we're able to dynamically flex the budget based off of the volume. So before we had variable spend of 361,000 for 89 million. When we increase it to 100 million, we flex it up to, 1.4 million in terms of spending, right? To give us a new total dollar amount, right? This is really where it becomes useful from a budgeting standpoint of a commercial team providing new finished good product mix and volumes, being able to very quickly flex this budget to capture new spending. And from that new spending, say, okay, well, based off of that, what is with the new volume, our final overhead rate being calculated? So we went from, a little over 1 cent to nearly 3 cents, right? And then finally, when we change just the budget, we have now a new pool of variable spending. The fixed spending has stayed the same, right? And we're going to divide it back by the same finished good volume in order to calculate now an overhead rate of 20 cents instead of 16 cents as it was before, right? So this is great for seeing the impact of the overhead rates themselves. How does that take effect in the products? So we're going to switch over to this results tab. And what you're able to see here is every single finished good SKU that has been affected has been identified and given a line. And then with this, the original and new costs. So you can very quickly say, okay, well, here's our list of affected products and what the true impact is on each one of the products based off making a few quick changes in just their overhead rates category. So that's a good overhead, that wraps up what I had in terms of overhead rate simulations. I'm going to tee up our third use case, which is going to cover, both the cost to deliver side of things, as well as being able to see sort of some end-to-end cost and profitability analysis itself, right? So the issue here is that companies tend to have a pretty large gap in the knowledge between gross and net profit. Obviously, at a corporate or maybe even a business unit level, there's often some visibility there. You're certainly going to have to, at a corporate level, calculate what both your gross and net profit are. But as you drill into more specific levels like customer or product, there's less clarity there typically, right? And so what our solution does is it brings a detailed allocation for every line of the P&L down to the individual product and customer basis, and sometimes even the transaction basis on the orders themselves. And this allows you to roll up reporting however you might want. That could be, at the customer product level, the customer group, ship to locations. You can do it the product side for product hierarchy, this group of products, this entire business unit, however you might want to roll things up, right? Now I'm quickly going to show another informational slide before we go into the software. So as you can see on the right-hand side, that's an example of sort of how you might roll things up in terms of the reporting structure. We're going to calculate or allocate dollars in terms of spending at the product customer level, or maybe even down to the delivery or delivery line level. And from here, you can summarize it up by DC, geography and region, line of business, and all the way back up to the overall enterprise level, right? And how do we do this, right? So you can see here, this is a waterfall P&L with different pools of spending. Now, within cost to serve, there are some things to consider like discounts and rebates and returns, as well as some other costs outside of just your cost of goods sold. But really our focus tends to be from gross profit to operating profit or net profit, right? Into these areas that, some sample areas I have here: distribution, freight, sales and marketing, SG&A, any value add or overhead service or other additional overheads, that type of thing, right? So how do we do this? Let's see it in action. I'm going to open up this software one more time, and I'm going to start by just going straight to a P&L for a particular period. So what we're looking at for this organization is a P&L for June. This is of 2017. It's a little bit older, but demo model of ours, just to level set sort of what the reporting structure looks like, right? So this is a sample P&L. Certainly for each one of our customers, the line items and names and categories of spending change, right? But for this example, This is all the different areas that we have pools of spending, and between gross profit and operating income, we can see that, we have within these line items, different categories of costs that we're allocating and calculating at the transactional level, right? So within distribution, we have several other activities. We have receiving, picking, packing, shipping. I'm going to expand on shipping, and you can see within that, we have then each distribution center location, right? So this is Australian based, so New South Wales, Queensland, Victoria, those sorts of things, right? Those are the states within Australia. And we can see our spending within each one of them. How do we capture or calculate the spending, right? That's the important thing. Let's drill into this activity, and we're going to be in a cost object once again. So this activity at the header level has some high level attributes, right? So what we've done here is we've captured using the GL some actual spending by category, right? So because this is a distribution and specifically shipping, it's high labor. We do have some other costs such as, rent and supplies, vehicles, those sorts of things that are contributing to the overall total cost of the activity for the period. We then get into the logic or methodology of defining how we're going to allocate it, right? This is really where I think the people come into play within our organization of being able to help you think through what the best allocation methodology is for each one of your pools of spending, right? And so we have for shipping a specific calculation, right, that's being applied. We have different calculations for other pools of spending you can see here. We have selected that we want to fully absorb all the dollars, and we're going to allocate it based off a certain amount of time at the individual transaction level. And then what are sort of the drivers and calculations and results, right? You can look through these drivers, the actual activity drivers here, but the results I think are really what's important to understand, and that is we had a total amount of minutes being almost 18,000 minutes. That combined with our total spending of a little over $26,000 gives us our per unit rate of $1.48 per minute, right? So how do we get there? So let's look at, give this just a second to load the list. This is every single transaction that took place in terms of shipping for this period of time, right? And we can see for each transaction what the product code and customer was, as well as some other order stuff such as, what warehouse location, customer category, product groups, etc., right? You can see here, I just skipped over, but the name, we're applying that allocation, shipping, and methodology, right? We then go through the calculation of capturing those driver statistics of, okay, well, here is all the different things that we need in order to calculate out what the time per transaction was. And then with the time per transaction, we can then apply it with our calculated rate of $1.48 to give us our total allocated cost on the individual transaction basis, right? Once again, I keep reiterating this at the transactional basis because that's the key to being able to roll up the reporting at any level that you might want to see, whether it's the product and or customer, and from there, the location, distribution center, business unit, etc. If I were to summarize this whole column, I'm just going to highlight everything you can see here in the bottom right. We have that $26,000 in total spending, which when we jump back to our initial P&L, if we go into that distribution line item for the actual location that I picked, that's how we were able to summarize up what that total amount was, right? So that's how we do sort of the calculation in the space of cost to serve. Let's look at some of the reporting that we're able to do with it, right? So I'm going to come into another view. This is sort of a branch manager dashboard or homepage that they might be able to at a manager level see some high level reporting. I'm going to select a particular scenario, and we're going to get some high level metrics. I really think it's good to be able to visualize the data itself, though, to tell the full story. So I'm going to open up the dashboard, and I'm just going to collapse that to give us a little bit more space, right? So what you see here is some high-level P&L metrics. So net sales, gross profit, operating expenses, and EBIT, right? By channel of distribution, right? So we can not only ship directly, but we can also use our trucks and then have what we'll call pickup service. We can see the sales reps that support this particular distribution center. As I click through them, you can see the list of their customers. And then finally down here below, we can see this scatter plot that I'm just going to full screen so we can really understand what's happening here, right? So what we're plotting is across the bottom, the gross margin, and then across the y-axis, the EBIT, or really the profitability of the customer itself, right? What you might expect is there to be sort of a linear bottom left to top right relation. Low gross margin, low profit, high gross margin, high profit. that seems to make sense to most people, right? But in reality, what you can see is that that's not really the case. People are scattered all over the place, right? Here in this top left, we have a low gross margin but high profit customer. That might be someone we want to look into as a good example of what a good customer of ours might look like. Down here at the bottom, we can see a cluster of companies that are high gross margin but losing us overall profit. And so we might want to drill into them and see, okay, well, how can we sort of retrain, or what can we shift in terms of how these customers operate in order to make them more profitable? And then you can also see here in the middle, Lowe's Electrical is a good example of just a large customer of ours that basically is about around break even, just slightly under break even in terms of profit. The size of the circle representing the overall net sales, so they're our biggest customer, right? If I was to click into Lowe's Electrical, we're able to see that same profitability waterfall that we saw on the slides, with real data here taking us from net sales all the way through gross profit and then through the cost to serve pools of spending all the way down to an EBIT where we're slightly losing money. All right. I'm going to jump back to the dashboard itself. And then I'm going to go into that Lowe's Electrical customer again, but at a more detailed level by double clicking them from the customer table there. You can see that we have here just some high level metrics. So the customer details, obviously the name of them, and then as well as some other things like some of the cost attributes, right? Some customer totals, hey, the total number of sales lines and total number of orders, shipped to quantities, those sorts of things. Some delivery metrics, other metrics in terms of dollars, right? Net sales per order, gross profit per order on average, those sorts of things. We had that same P&L we saw originally, but now at the individual customer level, as well as compared to the overall industry and corporate totals, right? So obviously this customer Lowe's is a part of the industry, so the net values are going to be smaller, but on a percentage basis, it's a good comparison. So we can see things that jump out like, to me here, what jumps out is on the warehousing line, we have an industry average of about 2.75%, a little over 3.5% on the corporate level, but a total for this customer of 7.25%, right? That's a big change, and that stands out to me. Maybe that's an area that we want to drill into and focus on. We can even see the activities within warehousing to maybe capture what specifically is so much more expensive for Lowe's Electrical. We're able to see the item groups at which they purchase with some of with the same line items of the P&L, but now pivoted out into columns, right? So for each one of these categories, we have of items for this customer, we have those same P&L metrics calculated. We have some channel results. Hey, based off the shipment channel, what were the sort of the statistics from the P&L in terms of margin, operating expense, and then percentages of those, right? All the profit centers that incurred both profit and cost throughout the orders for this customer. Some high level performance metrics. Some of these are the same as what's on the P&L, but we do go to a lower level of detail calculation, doing stuff like calculating delivery dollar per mile for this customer, right? So we have on average 62 cents per mile in terms of delivery cost. And then finally, employee details for employee or employees that incurred cost as a result of the orders from this customer. And really what becomes powerful is, not only we're reporting actual metrics of this, but let's go into some analysis, right? I'm going to, from this particular customer and period of time, right, open up a simulation. You can see now I'm in a simulation. It's suffixed with sim in the sort of object name, right? We're going to start with that same P&L we saw before, but rather than comparing it to the industry standard and corporate standard, we're actually going to be able to compare it to the simulated result, right? And how do we do that? So I'm going to skip over to the simulation selections and start playing with some of the actual metrics that we can change. So something that jumps out to me looking at this screen is that we have a shipment frequency of 69 deliveries utilizing our trucks per this month, right? This is what would that be? July of 2017, right? So that's averaging a little over 2 trucks or 2 shipments a day being delivered. That seems like an area that we might want to hone in on, right? So I'm going to go ahead and turn this line on, and I'm going to change this down just to 31. So what if we were able to get this customer to agree to taking 1 truck a day instead of maybe a little over 2 on average, right? I'm going to go ahead and hit calculate to see what the results of this simulation are. And then now that that's completed calculating, I'm going to come back to that profit, that P&L, and see what the effects of it are, right? So we can see, obviously, the delivery line has been highly affected, right? We were able to save 41% in terms of cost. But some other lines and categories of spending were also affected, right? Inside sales, we were able to save some money on, as well as warehousing. These are activities in warehousing that are probably likely tied to the delivery, such as picking and packing, that sort of thing, right? So being able to gain some efficiencies there. The model is intuitive enough to know that we're going to capture savings outside of just purely delivering by changing the shipment, the number of trucks in the shipment. We're going to summarize these up to now see that, in terms of EBIT, we've gone from losing almost $3,000 a month for this customer to now gaining $2,500 a month on this customer, right? So that's a savings of 185, almost 186%, which is very impactful. So maybe this is something that our commercial team might want to take to Lowe's in order to explain, hey, if we aren't able to consolidate some of these shipments, then maybe we need to renegotiate the pricing side of things, right? In order to make this customer profitable. So that was the third and final use case that we had to show in the software. Let's look at some real world results in terms of a case study, right? So this is a customer of ours, Injuries International, who is a distributor of fasteners, which means that they don't specifically have a great use case for the cost to make space. They're actually purchasing and reselling and distributing fasteners, right? But we do some good work for them around cost to source and really cost to deliver for this customer, right? So 1 year after going live, these are results that they were able to gain some insights into, right? And that is they saw 3% of their customers made up 85% of their EBITDA, right? That's really, really, that's really, really valuable insight for them. It was amazing that they had no idea that 3% of their customers were making up such a huge portion of their profit, right? 55% of their customers made up essentially all of their profit, whereas 15% were about net zero. And then the final 30% were actually losing them profit or EBITDA in this case, right? And then they were also able to identify that 60% of their customers were less than $10,000 in revenue, and 25% of their customers were $10,000 to $100,000 in revenue, right? So a huge portion of their customers, right, 85% are, between this $0 to $100,000 in revenue, and within there, a large portion of them are losing or are negative in terms of profit, right? So that's what they were able to sort of summarize here on this graph or table on the right-hand side, is that you can see most of the customers, like I said, were 0 to 10,000 or 10 to 100,000. And in terms of net revenue, they're obviously not a very high revenue because of the size of the customers by nature, right? But really, these were the categories of customers that were really tend to lose them money. So what they are able to do is they're going back to their smaller individual customers and drilling into, okay, well, what is costing us more for these that are larger customers it's not costing us money on? And running the exact same simulation tools that we took a look at, what they identified is that they didn't have enough profit margin built into their products to account for the picking and packing operations within the warehouse, right? There's a lot of these customers, so a large volume of the picking and packing that was happening was for these customers. And while they charged for freight specifically, they didn't necessarily charge for picking and packing activities. And that's where they were really bleeding margin. And so what they've done and been able to do is go back to these customers, and they're now in the process of renegotiating, well, what can we do in terms of either increasing the profit margin on the product or adding line items to charge for accounting for the cost of the picking and packing operations for these lower revenue customers, right? One thing that we really try to reiterate and stress to our customers when you do a profitability study is it's important to not just go about firing your customers that are losing you money. Really try to retrain them or change what they're doing on an activity basis to make them profitable. Because if you just start firing customers, your overall potential is going to shrink as well, right? So that leads us into our final poll question. Rafe, if you want to pop it up for us.
Okay, and here it is. So third question is, what is the key benefit of conducting cost to serve analysis using a centralized platform like ImpactECS? First choice, provides visibility into all components of serving a customer. Second, simplifies supplier onboarding process. Next, eliminates the need for financial audits. And finally, focuses only on reducing direct manufacturing costs. So please make your selection quickly so we can end the poll and move on.
While folks are answering, Sam, I'll jump in and ask you a quick question. We saw a lot of screens just now.
Yeah.
How does that all work? Like, are these predefined screens? How are you working with customers to understand these models? I know Reema mentioned a little bit earlier about, each model is unique and specific, but maybe you can just give a little more layers into that so folks can understand how they're getting to see these different types of simulations or cost objects or things like that.
Yeah, it's a great question, Stacey. So that really ties into the model building conversation and explanation that Reema gave earlier, right? All these different screens and user interfaces and then the calculation methodology behind what goes into producing the results within them, those are all unique and specific to each one of our customers, right? So even down to sort of the home pages or landing pages that you saw me start at in terms of navigation, we really design our models custom configured to each one of our customers for what they're trying to accomplish, right? Some of those cost to serve, some of the cost to serve screens that we saw might be more for distributors or service-based industries, but also for manufacturers. And it gets into, beyond just customer specific models, we build screens and UIs down to the individual user group. So maybe it's someone who's focused on profitability within a manufacturing organization that's going through that sort of cost to serve analysis. Whereas a pure costing team might be more in the weeds of calculating what the overhead rates are, or a sourcing team might be in the weeds of seeing what the results of potential new tariffs are, right? So we're really building these screens and that you saw unique to each one of our customers, specific to what their goals and what their logic and calculation methodology is, right? That is really how all things are really brought together within ImpactECS. Does that answer the question, you think?
Absolutely. Thanks, Sam.
Okay, and the results are in for the final question. It's almost unanimous again, and it's consistent with the case study you just showed, and that it provides visibility into all components of serving a customer.
Yeah, thanks, Rafe. So I'm going to wrap things up with one final slide here. So we want to leave you with what are really the keys to, bringing everything, all your costing and profitability into one single integrated platform, right? So obviously you're going to hopefully get enhanced visibility and more agile what-if simulations in order to be able to make more data-driven decisions and systematize the framework for your decision-making. With that, you also get some of the tools that come along with it, like being able to see revisions, versions, and history of cost and profitability, as well as the controls around user groups and users of what they're able to do and see within the model to empower the teams to be more effective and spend more time doing analysis versus just data manipulation and cleaning up and actually getting the calculations done. And then the final thing that I think really I want to stress is the retention of the tribal knowledge. Reema called out why that is a risk factor to organizations, right? But how many people do we know that if they won the lottery and didn't show up to work tomorrow, they were the total owner of a process or a workbook or something that, you'd have to totally reinvent, right? So you're able to systematize that tribal knowledge and have some retention for the methodology that goes along with it, right? So with that said, we're basically at time. We're going to just, wrap up here with any more questions that the audience might have. And as well as if you have questions later on down the road, some ways to contact us, feel free to reach out through, phone, email, contact us on our website or LinkedIn pages in order to ask any questions that you might have in the future.
Sam, we do have one question from the audience that it's a pretty big one, so I'm going to just throw it out there. We only have 2 minutes left, so I don't know how far we can get into the details, but what has been a major lesson learned by successfully implementing these costing and profitability models? Like what's a big aha for you or you think as a company that we've gotten?
Yeah, I think the biggest aha is really spoken to in that case study of, folks tend to have an idea of how their business is being run and where, they're gaining profit, where they're gaining revenue, which from one customer to the next, we see those assumptions get broken down, right? And it might be, in the injuries example, the big one was that they had no idea that just 3% of their customers made up 85%, I think it was, of their profit. We see results like that, on a continuous basis for each one of our customers. They think they understand what a product costs to make, and they go into the details of it and they say, wow, that was wrong. We had really wrong assumptions. The methodology didn't necessarily change, but being able to more accurately systematize how you're doing the calculation analysis, you're getting just different results than what they expected, right? That's the biggest takeaway. It's not necessarily one takeaway from all the customers, but it's really challenging the assumptions that they had going in, or those assumptions being challenged by the results of the data.
So I have launched the end of webinar poll, and please be sure to answer the question before you leave. Thank you, Sam and Reema, for an amazing session today. It's great to see the ability of the ImpactECS platform. It's help answer questions that a lot of companies are struggling with today, and I think a lot of them could benefit from using that your product. So again, and thank you, Stacy, as well, for helping facilitate the questions. And thank you, everyone, for attending today. Keep an eye on PACE's channel on LinkedIn for future webinars. Sign up for our newsletter, and we'll let you know details of our forthcoming sessions. And with that, have a good day.
Thank you, Rafe. Thank you, Pace. And thank you, everybody, for joining us today. It's been a pleasure.
Thank you, everyone. It's been great. Talk to you soon.
Bye-bye.